have with us Devina Mehra also joining us. Devina, how do you look at the entire West Asia crisis? You have markets, moving strongly based on what's coming from Trump, but the oil markets are holding off with the Brent above $100.
Yeah, good morning. Very difficult to say what will happen on the crisis. My view, much before this crisis unfolded in January, somebody had asked me about Iran and my opinion, which is actually a totally layperson opinion. I'm no geopolitical expert. Was that if you hit Iran, you're going to be hit back hard because it is not. Pushover. It's a country with 90 million people. It has, arsenal, which is, I specifically mentioned that, and they have a very favorable geography, which is very anti any kind of invasion. The mountains and the deserts. As far as even when adversaries are very mismatched, who can be more mismatched than U.S. and Vietnam in the 60s or U.S. and Afghanistan later? The victories are not easy to come by. And but the news flow on this war has been such that every day it's a new story. As someone was saying that there's no need for April Fool jokes. Currently everything possible about the war, what will happen on the war, has been said by the person most important in this, which is President Trump, and often within 5 minutes of each other. But leaving that aside, see, you have to take the big picture, and the big picture is that geopolitics beyond a point does not influence stock market movements. That's the 120-year history from the beginning of the 20th century that we had done an exercise which went back 50, 55 years. Financial Times did it 120 years, and they came to the same conclusion that broadly you should not react too much to geopolitics. Of course, for India, the question is oil, because we are a big oil importer. And at least for us, the Straits of Hormuz are open, it appears. So at least, we are not as stuck as some of the other countries. So that's a positive. But yes, there will be pressure on all fronts, including to some extent on corporate earnings, also given that petrochemicals are an important input. But oil had been at a kind of a low phase for a very long time. So even February beginning, when we did our global rebalance, actually the only real change we made was we were already underweight US equities. We took out some more money out of US equities and put it in commodities, oils and metals. So that, we could see that the trajectory was due anyway for an upward move. This, of course, day-to-day gyrations have been all because of the news flow and what's happening on the ground. But it might settle down to a slightly higher number than what it was pre all this of starting to bomb Iran with, I don't even know what the end game was. Because now they're saying that, yes, we will withdraw and let the other countries figure out how to open the straits. But as I said, change tomorrow.
Devina, if that is the case, do you think that even if US withdraws in 2 to 3 weeks, you're going to still have a problem in hand because all the countries who need Strait of Hormuz will have to now individually negotiate with Iran?
Yeah, so effectively your cost might go up a bit, but then Iran is supposed to be India's friend. So hopefully we get a better deal and it doesn't hurt us quite as much. But, on the rupee, yes, in 2025, when dollar was weakening against all other currencies, it still strengthened against the rupee. So which was something we lost out in terms of the focus, because we look at only the rupee dollar. Now, of course, the dollar has been actually strengthening against many other currencies also. So that is definitely one pressure to manage. And RBI did spend a lot of money trying to defend the rupee, but that didn't quite work out. And also now, even structurally, you have an interest rate situation also, which puts pressure on the currency, because now your interest rates are only 2.5% higher than the West, whereas the earlier norm used to be 5.5. At the peak, it was a 7% differential. So that also puts pressure on the currency. But as far as the markets are concerned, I think, At least some of our indicators also show that it is somewhere in the bottom range, which doesn't mean that it necessarily starts moving up tomorrow, but uh, in equities, you always have to take the big picture because the markets always frustrate you. Yesterday, I posted on Rakesh Jhunjhunwala also, and one of his in the book about him. I thought the only relevant, really relevant line was that he said, I made a lot of money from 89 to 92, from 2003 to 2007, from 2009 to 11. In between, there were even 5 years where I didn't make money. And that's the data. I mean, from 1994 to 2003, the net displacement in the Sensex was zero. But then in the next 4.5 years, it went up 6 times. So, that's the nature of equity markets. But I think for whatever is your equity allocation, which I repeat like a broken record, should never be 100% of your portfolio, it is time to remain invested.
Sure. But Devina, is this that 2020 kind of COVID low moment where you go all in? Because the news flow is really not settling down. And then you've got that big overhang of what you're going to hear in the earnings. And then always accidents like HDFC Bank here and there.
So, I mean, if you remember, I mean, if in 2020 March, I had told you that not only would COVID kill millions of people, there will be whole industries where the revenues would actually go to zero. I mean, retail, airlines, hotels, autos, revenues went to zero or near zero. Could you have ever predicted that you'll see a bull run? So, markets are in hindsight, we can always find reason. Yes, liquidity was injected, and this happened and that happened. But I can 100% say that that people would not have predicted. But I mean, on 23rd March 2020, we did say that go all in, or go in rather. I mean, we didn't know how long the bull run would go on. That I wouldn't say, but we could see that there would be a sharp up move. So as I said, I mean, I think, we are in the range now, whether as the move starts tomorrow or it starts, few weeks or months later, I think we are definitely in the range where you should be invested. And as far as banks are concerned, you've heard me say this before, that I'm always a nervous investor in banks because structurally it's a business where you will see more negative surprises than positive surprises. And every year there are 2 or 3 of those, sometimes from the credit book, sometimes from the trade book, somewhere or the other. And the whole problem is that as an outsider, there's no way you can see where those things are hiding. So, you're out on a wing and a prayer that the management is doing what they're supposed to do. So, that's the structure of banking. Unfortunately, it's the highest weight in the index, so you can't ignore it completely, but it's a structural issue.
So, Devina, if someone has been sitting with some powder dry, I mean, of course, the risk appetite for each and every investor is quite different. But what would you recommend buying right now?
So I can tell you where we are overweight in our PMS. We have been overweight pharma healthcare for over 2 years. So we continue to be overweight there. We've also been overweight auto components and auto. Now you can say that energy, if petrol and diesel prices go up, will make a difference. But as of now, we are still there. Banking, while we are not holding, anywhere close to the market weight, but we are holding more than what we often do. So let's say more than what we were holding in 2024. That's broadly as far as sectors are concerned. That in FMCG, in chemicals, in capital goods, all these also we have stocks because we always have a fairly diversified basket. We had added metals also. I mean, when I said we added some commodities in February, so it wasn't just oil. We'd added metals also. So that. So broadly, that would be the landscape of what we are holding. But I always advocate a diversified portfolio and never have like 35-40% in a single sector or anything like that, let alone stocks.
Devina, I want to go back and revisit that banking argument you made. You're a nervous investor in banks, but how much of this is already in the price now? I'm trying to get a sense because there were banks which are trading at 20 times earnings, 18, 19, 20 times earnings, which are now trading at 13, 12, 13 times earnings. So there's a substantial discount available. These are not P ratios or PB ratios, for that matter, that we've ever seen an HDFC Bank trade at in particular. Right. I know you can't talk stock specific, but give us a sense, therefore. Is this a good opportunity to buy?
Yeah, so I've already said that while I'm not overweight banks, I'm holding more than what I usually do. Would be a little bit more skewed towards PSU banks, I would think. But I mean, we do hold private sector banks also. So, that's, it was that if you go from 2020 to 2024, the 5 calendar years, banking underperformed every single year barring 2022. So 2022 was the last time we were kind of close to market weight on banks. And then, last year is when we again built up higher than normal positions. So we continue to hold that. But, as I said, that I am a nervous investor because you don't know where. And we've seen in the past year itself, this is the third private sector bank where we've had a negative surprise. So, in a sense. So, but I hope the problems are contained as of now, there is no real new problem that has surfaced, at least to the extent I have seen the news. So it's more sentiment. And yes, you are right that the valuations are cheaper than they have ever been. So I hope they manage to get their act together.
We so hope so too. I mean, not just for them, but keeping our fingers crossed for all the news flow all around the world. But Devina, good chatting with you as always. Thanks for your time.
Thank you.